Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So I'm going to freely share my opinions as we go through this, and let's see what people are sharing on social media. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics, deeper into the sectors, into individual companies. I more freely share my opinions about companies and my portfolio strategies and how I'm playing this commodity bull market that we are in. We do have a coupon code going on, Mayday, M-A-Y-D-A-Y, one word, and it is still active for a 50% discount on the first month if you want to try it out. It's only on the first month, and a larger discount on the yearly membership. And you can always switch over to the yearly membership if you'd like. So, Investing for Beginners podcast that says the best way to minimize risk is to think, says Warren Buffett. And a lot of people think that risk is inherent to the company. That is not just the case. There's a lot of risk that I would say is put on the investor. When you buy commodity companies, the commodity companies and equities move in cycles. And that's really what you need to understand, is that equities like stocks and NASDAQ and tech stocks like that, and commodities move at different times, different cycles. And you want to gain your exposure to commodity stocks during the right time. It's not timing the market on a short-term basis. It is timing the market when commodity stocks and equities are down. And then they generally take about 5 to 15 years of an up move for those commodities to revalue themselves against financial assets, like other technology stocks, bonds, and stuff like that. So your risk isn't just contained to the stock. There's risk within the company and the stock. There's risk outside of the company that can impact it, like a country that it's operating in. And that could be from a variety of different things: taxes, nationalization, et cetera, et cetera. And then there's also, the investor and the risks and the entry points. A lot of risk is minimized by your entry point. Your entry point is a large factor for risk, as weird as that seems. And Buffett would agree. The way that Buffett invests is he identifies where the value is in the market. That's where the price has fallen drastically under the value of the business, and then he buys it. So ultimately, what he's doing is he's identifying where the value is in the market, and he's minimizing his risk by his entry point of the valuation of that company. And that's how he is minimizing his risk. And he's using strategies and things that he has developed over his investment career to identify when those low risk entry points are. And he may even wait until the whole market sells off to deploy large sums of capital, because the price falls way below the value of the company that he's looking at. Charlie says the longer the time horizon, the less the variability in average annual returns. Investors should not underestimate their time horizon, says Jack Bogle. So if you look, you can get short-term maximums and minimums. So you can see in the short term, you can go up or down quite dramatically. But as time goes on, you can see your losses dramatically go up. So your your underperformance is 8% or minimum, and your maximum is 13.6. And you can see the difference there. What I am trying to do, and the strategies that I'm trying to deploy, is to find where the symmetry is the largest and the valuations are the most, I'll call it upset. It's where the valuations are blown to the downside, but you've got all this upside potential. We are gaming the equities, the companies, as it's ultimately a leveraged play to the commodity itself. That's what we're doing. And in history, when these valuations get out of whack, you can make decades of returns in multiple decades of returns, 20, 30, 40 times your money in a shorter time frame. You do have to live with a lot greater volatility to do it. And you have to ride through it. So it does take a little bit more emotional control to get through it. But that's how you get these outsized returns in shorter periods of time. You have to go into highly volatile stuff, and then you have to time your entry point where the entry point's a decent entry point where your risk reward is very favorable. It's very asymmetric, big upside potential with a lot less downside. No one's going to time it perfectly. And that's why you're going to have to adopt the longer approach here. So really what you're doing is you're looking for sectors or individual companies. It's usually a combination of both the sector and the company in that sector where something gets blown out. You buy it and you wait until the valuation becomes overvalued. So you go from an undervalued state to an overvalued state. And if you're playing it in the commodity sector where the commodity can also move dramatically, you can get 30 times your money, 40 times your money, 50 times your money if you're brave enough to buy anywhere near the bottom. That does not disclude you from riding through massive volatility along the way. A lot of the times you won't time it perfectly, so every entry point you will be down at some point in the beginning. And then you will also probably experience a couple of 30 to 50% pullbacks along the way of making these outsized returns. So emotional control is absolutely necessary when taking on these investments. Berg says risk is the likelihood of permanent capital loss, not volatility. Opportunity risk is the likelihood of missing out on potential gains, says Howard Marks. So yeah, risk is the likelihood of permanent capital loss, but you have to keep in mind that if every entry point isn't timed perfectly, which it won't be, you will be down on a stock 20, 30, 40% in the beginning when you first buy it the first 6 months, year. Which also means that your time frame that you adopt has to be longer than a few months. So the risk of the likelihood of permanent capital loss is a combination of going into a stock, knowing what you're doing, and having a long enough time frame for the inflection or turnaround of that commodity sector to actually turn. You can use everything at your disposal. You can use ratios, technical analysis, and everything, and you won't be perfect in all of your entry points. You don't need to win on every single position. The symmetry will carry your portfolio higher. So you can have 30% or 40% of the stocks not perform to your liking. But as long as you've got a couple of absolute brushers, like 30, 40, 50 times your money, and you put enough money in there, it will carry the entire portfolio for you. So there's a lot of strategy. There's a lot of things that you have to think about when you set this all up. It's not just risk in a company, and there's a lot of risk about your entry point. Your entry point is more important than what most people think. Investment Wisdom says risk to us is 1, the risk of permanent loss of capital, or 2, the risk of inadequate return, for Charlie Munger. What I like to invest in is the commodities because it's really just a leveraged way of playing a commodity. And the commodity, sometimes if you can identify huge imbalances, like uranium, and I know we've got a lot of uranium investors, they understand that the commodity could go up ballistically, like it could go up multiple hundreds of dollars, and then the equities are just a leveraged way to play that commodity price movement. And we're waiting for that to basically go through that shortage or that money flow coming into the sector. That's what we're all waiting for. And that's where you get the big returns. So here's a couple of ratios. I just threw these up here, GDX to SILJ and GDX to URNM. To me, it looks like SILJ, which is the Silver Junior Miner ETF, could outperform GDX, which is the larger market cap gold mining companies. And you can see that we've got a trend line that's broken to the downside, and maybe we can get a outperformance of Silver Junior companies. So that is where I'm looking. Also notice, I did one yesterday, another clip on how silver is breaking a big cup and handle pattern. SILJ, if we're positioned up here and it's this cheap, is absolutely going to fly if silver does hit anywhere near those price projections of, a couple $100 an ounce. So SILJ, in my opinion, when you start pricing these assets against other assets, you're like, wow, this thing is really cheap. We could have a really big move in the junior silver mining companies. And that is money flows that are causing that movement. It's money from other sectors like the bond market. Not all of that money transfers over. It's some of that money. So some of the money transfers over. It finds its way into SILJ or even the gold mining companies, and that's what moves it. But what if we have a market condition where people panic? Much like the 1970s, where they panic out of bonds because interest rates are going up. Perhaps we could also see money rotate out of technology stocks, much like the year 2000, 2001. And that money goes and rotates like it did last time into commodities and precious metals. I also think that the setup is much better than the 2000s bull market based off of XAU to gold ratio. We are bottoming from a very low valuation point of gold and silver mining companies against gold itself, and then we're going to start to come on up. So if we get that alignment that I always look for, where gold and silver mining companies go up alongside gold, and gold rips it, and I'm going to show you a couple of setups here with gold, where gold could revalue itself to much higher levels. We could see gold and silver mining companies do some really crazy stuff. Fingers crossed. Hopefully that's the case. We also have GDX versus URNM, and I know I've got a lot of uranium bulls, and I'm not stating that this is 100% correct, but it's data. We had a big outperformance of URNM coming down against GDX, and one of the things that has changed is we went from a uninverted yield curve to an inverted yield curve. And then we might come back and uninvert. When that uninversion occurs, that's when GDX and SILJ outperform some of these energy ETFs. We haven't uninverted yet, so I'm not claiming that process is going through right now, but it's something I'm watching, and my allocation is shifting between assets based off where the yield curve is located. So there's also that going on. And we've been doing that on the website. We've been buying up some of these gold and silver mining companies off bottoms over the past 6 months, year. Coming on down to gold to M2 money supply. This is one of the charts I was referring to earlier, where we're starting to get gold to outperform the M2 money supply. And under certain market conditions, this breaks out and will probably and maybe even test its all-time highs again back in the late 70s, early 80s. This is a double bottom. Bottom one, bottom two. So we've got this double bottom going on against gold, against the M2 money supply, where it revalues itself. And what this is telling us is that the market conditions have already changed for this to occur. That's why we're seeing these two assets priced against each other moving upward in this configuration of gold divided by M2 money supply. That's the same configuration that occurred in the early 70s, where it revalued all the way up. And that is a sign that the same market conditions could potentially be coming. And if this is a double bottom, we'll hit this up here, the blue resistance line, and we could continue all the way up to the top here, depending on the market conditions and how people feel the psychology of the herd, um, basically trading assets under those market conditions. Here's another one. I've got gold divided by total bank credit. Bank credit is also money coming into the system, and it does get accounted for in the M2 money supply. But that's also, it's a very similar chart. You can see the big movement in 70s. And I think another movement, upward movement, where gold's going to outperform is coming. Here's some more data. A lot of these bull markets occur under the real estate cycle of an expansion phase. And this is just more data showing you how strong at least these three categories are in real estate. And I always want to watch this because these are leading indicators of the real estate cycle and where we're at in that cycle. So we've got total construction spending in the United States. That is way up there, and it's continuing to be at a very high level. You can see it rolled over in 06, and then we had our crash in 08. You can see that it was rolling over, and it was in process of rolling over in 2006. We are not rolling over yet, that I can tell. So we've just been going a little bit sideways for the past few months, but it still looks strong. This is all employees construction. Another one, when we look back at last cycle, it was rolling over in 05, 06 and really started to decline in 07, 08 and 09. So it was rolling, it was in the process of rolling over for a while. And what you want to look for is you want to look for all of these things to kind of occur simultaneously. I call it the confluence of information, which is the gathering of all these different pieces of information. You sum them all up and you say, yep, this is probably what's going to occur. Maybe we should exit the market. Now, I don't see any signs of this rolling over yet. So right now, all employees construction look pretty strong. And this is where a lot of unemployment comes from. It comes from all employees construction. Coming on over, we've got total construction spending, residential in the United States. We did have a rollover here in 23 lower, and we're kind of coming back up real slowly. You can see last market, we completely rolled over in 06, and we just dive bombed. So that is one of the things to look for is a dive bomb in total construction spending in residential in the United States. Why is that important? Because that's a big driver of credit growth of the M2 money supply is coming from the residential loans in the system. So when we see the home builders, when we see housing starts, when we see the spending and all employees construction all start to turn over, those are early indications of a potential slowdown that is coming. And these are the home builders. So we can look at the home builders as well. So when we look at the home builders here, we can see that we had a shoulder, head, shoulder, top pattern right in 2005, 2006, and then it broke down in 2008. So the home builders were actually breaking downward in 2008 at that time, and it led the crash. So if you were to look at home builders and you were to look at all these different metrics that we just went over, those are all leading to potential crashes. And if you look now, we've broken out of the consolidation to the upside. This makes me think that something big is coming in housing, which also makes me think that the expansion phase is alive and well, and that we're going to get a big commodity boom. Here's another one too. This is Meritage Homes. You can see we peaked in 2005 and headed lower. In this, big move lower, and that consolidation of that move lower was an indication that a crash was coming. We do not have that here recently. We could very well pull back and do a retest, but this is broken to the upside. Completely different picture when I look at this. And the conclusions, I cannot come to a market crash with this breaking to the upside. And Toll Brothers is doing the same thing. It's breaking higher, not lower. And we had a big pullback in 05 onward in a lot of these home builders. So that is not equivalent to what we've seen before. Today is not equivalent to what we've seen before big crashes, at least real estate driven ones. Lithium pulling back still perhaps to support. What do you think? and this is the support level, and maybe we've got a bigger pullback here. And I know some people are always asking, is it a good time to enter lithium? I think we're still early. I think we're still early. We've got support underneath us around $36 a share, and I think we could, it's possible, to do a retest there. A lot of people say ESG is dead. Maybe so, maybe not. But that's generally when you want to buy, is when everybody's telling you it's dead. Gold looking solid with a falling wedge short term. Long term, it looks real excellent. So I put in a long term chart. This thing's breaking all these consolidation periods to the upside. So that looks great on a long term perspective. On a short term perspective, we've got a falling wedge that's coming and squeezing into the corner there, where that will also, it also looks pretty good on the short term. And I know people are trying to play this in the short term, but I just ride it for the long term. And gold's going to do well as long as all of those other construction leading indicators are doing well. That's usually when gold goes up and does a revaluation. I put this on here. It says good or bad stock for investment based off this chart. I think this chart looks absolutely awesome. It's a double bottom. It's squeezed up. We entered in this squeeze up here in the corner. We've broken out of all these downtrends, and we're probably going to get a retest here in the short term. I did not sell. I'm not trying to time the short term, but we've gone from stage 1 to a stage 2, which we're probably going to get a big upside move in a lot of these commodity stocks. Investment wisdom, it says, I don't know how to predict the stock market. I don't know how to predict interest rates. I don't know how to predict business. All I know is if I buy the right kind of business at the right price with the right people, I will do well over time. So he takes a long enough time frame. He plunks his money at the right time. So his entry point is how he's controlling his risk, because the value of the business is below, the price of the business is below the value of the business. And he waits long enough for it to revalue. It's exactly the same strategy that I basically replicated and put forward to commodities. So this is the M2 money supply. It's now expanding from a year ago. We're going into positive territory. They did the reverse repo here, which was also basically injecting a bunch of money. So there's that going on as well, where we're entering a positive M2 money supply. And this negative portion, I think, was coming from the reverse repo. So we never actually contracted on money supply, in my opinion. And if you were to do M2 money supply times money velocity, that is your GDP, and GDP never declined. So I think we've been going up the entire time. So I'm going to skip that one. It says too much capital availability makes money flow to the wrong places. That's malinvestment is what a lot of people call, and that's when too much money and capital's in the market. Think of it as money flowing over into Bitcoin and maybe some of these very speculative places. When that dries up, they will most likely crash. It says, would you buy this stock or sell it? I would sell it. Anything that goes vertical like this is most likely overvalued, and I would sell it because I would definitely not buy it. Buying it up here, most likely your valuations are bad. You're losing your symmetry, and your risk is going up as it goes up. So you want to buy undervalued assets generally from a base. Your base would look something on the lines of this at the bottom here. So you buy it here or down here if you're real patient, but not when it starts to go vertical like that. That's generally where you lose your symmetry. So that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. And we'll catch you guys later. This is Finding Value.